Hello, everyone. Thank you for joining us on this Portfolio Partners chat with one of our fund managers. This is where you meet your fund managers. Today we have Bronwyn Blood, who is with Granate Asset Management. And Bronwyn has been in the industry for quite a while now. Exactly when did you join the industry, Bronwyn?
Oh, like late 90s, a long time ago.
Late 90s. Well,
Yeah,
welcome and thank you for coming on the show today. So
pleasure.
Bronwyn
Thanks
had
for having me.
my pleasure. Yeah. Bronwyn has a BCom from Natal, joined the industry in the late 90s, started with one of the other asset management firms back in 2006, and then moved to Granite in 2015. And I think that you've been running these strategies since 2015. Is that correct, Roman? Yeah.
Yeah, actually, yeah, before that. So I
Oh,
managed income funds since 2006. Yeah.
right. Yeah, that was under another banner that
Under
then got
another
taken
banner,
over.
yes.
Yeah.
Yes.
Okay. Right. So, Roman, let's get started by asking you about the performance of your income fund uh, over time, and introduce us to your fund itself. Yeah.
Okay, thanks, Jim, and thanks very much for having me today. Yeah, so this fund is in the multi-asset income sector, which obviously it aims to achieve consistent returns above your cash type benchmark. So anything sort of over and above inflation plus three or Steffi plus a cash plus type benchmark. But the most important thing is that we achieve consistent returns over time. And I think the next slide will show you that we have actually managed to achieve that. So Jim mentioned that we launched this fund in 2016. It was April 2016. So we almost next April are 10 years in. We have managed over all periods to achieve and not only above Steffi plus one, but in actual fact above Steffi plus two. So a really nice yield enhancement above cash. But the most important thing for us is that on a risk adjusted basis, we are doing very well, and not only very well for us, but very well compared to the competitors in the landscape. When we compare ourselves against all the competitors, we measure ourselves on different ratios, etc. And as long as we are consistent, i.e., you're not going to get any surprises in this fund where there's going to be a big drawdown in capital, then we're not doing our jobs properly. So, yeah, I mean, I think over 1 year, 2 years, 3 years to get above 10% over all periods is pretty much good when you compare what you'd be getting on a bank deposit or any other sort of cash return.
Well, that's one of the things that impressed us about your fund when we first started looking at it is that the returns are very smooth. You know, so as you mentioned, you don't want people to get unexpected big drawdowns and
Mm,
so on. And that when we look at the performance, that's pretty obvious on the charts. So well
mm.
done on that score.
Thank you.
We don't need more surprises in this life, I think.
Definitely
Yeah,
not.
yeah. So then when you talk about performance, you also have to talk about how much risk you're taking to
hmm
get that performance. So how does your fund measure up on that score?
Okay, so this chart actually shows it quite nicely. So what we've done here is we've plotted our fund, which is the red dot, against all the other little blue dots in the multi-asset income category. And then we've measured ourselves on an annualized return basis, so what our returns are compared to the competitors. And you can see they're right up there over the long term. But also the x-axis shows the Sharpe ratio, which is a measurement of risk. So it's a measurement of almost risk-adjusted returns. And obviously, the higher your Sharpe ratio, the better your fund is compared to the competitors. So that's really what's important to us is that if we have a higher Sharpe ratio, not only a high return, but a high risk-adjusted return, then we are, achieving what we aim to achieve. And I think, the questions hopefully it'll come out how we do that. But it is basically by understanding all the different sectors within the fixed income universe and managing the fund on an asset allocation basis appropriately to achieve that consistency over time.
Well, it's quite remarkable comparing yourself to your peers because there's only one of the peers that's averaged a higher return, but
Yeah.
they've done it with more risk, haven't they?
Yes,
So,
they have. Yeah. So that's
and then,
exactly right. So the blue dot, I mean, I can't point on this, I don't think, but you can see it there
yeah,
where the
yeah,
Sharpe ratio is just under 1 would be, a very high return. And actually, it's also quite interesting, the all bond index, that yellow dot.
mm,
We've been through a period where bonds have really performed exceptionally well. We've never seen this kind of performance from the bond market. But
yeah,
actually, if you compare our fund to the all bond index over time, we've also managed to achieve that an outperformance of that index for probably 95% of the time as well, which is very good because you can see their Sharpe ratio is a lot lower.
right. So, Bronwyn, I take it you have to be pretty active to achieve this. I don't imagine you just make a whole set of decisions, then, just sit there for 10 years and get the returns. So
No.
wouldn't that be great?
Yeah,
Uh,
it would be great.
yeah.
No.
So how has your allocation changed over the years to achieve this?
Yeah. So I think what we pride ourselves on is obviously understanding all the different sectors of the income market. And you can see on the right-hand side, you don't just invest in one asset, one type of asset. Like we don't just, as Jim says, sit in bonds and, just sit there for the rest of time. There's
Mm,
all sorts of ways of bringing yield enhancement into the fund. So on the right-hand side, you'll see all the different types of asset classes that are within the income sector and how we've utilized those over time and changed the asset allocation according to whatever macro backdrop we might be in. So for instance, you can see there was a big change in COVID, for instance, where, that 2020 point where the fund went from being very allocated to a lot of corporate bonds, etc., to completely changing the asset allocation. And that was because of a big yield curve steepening. There was massive changes to the repo rate, and we had to move according to that and to make sure our investors were exposed to the best parts of what the universe had to offer. And I think,
mm,
over time, we've managed to make sure that there is proper diversification. There's hundreds of instruments within this fund, different types of instruments that we bought at different times, according to what the macro backdrop is at the time.
yeah. So since like 22, 23, you've been adding a lot more government bonds to that and some
Mhm.
foreign investments as well. Can you
Yes.
So what has motivated you to go offshore with where are you getting a good return in the offshore market?
Yeah, so that's actually a great question because, you'll see that how the market has changed, that sort of very large allocation to local credit before
Mm,
2020, which was so that pink area of the graph, was because, we were in an environment of very high yields and we had nice corporate bond exposures in our market. Lately, what's happened is it's almost reversed, where our credit spreads or our yields in the corporate sector have narrowed significantly, and we've had almost a crowding out of our government bonds versus corporates, versus in the foreign bond market where we've had some attractive credit opportunities. So attractive corporate bond opportunities where, for instance, we've gone into things like even just South African sovereign bonds or, a bond on a company like Anglo American or Bidvest that issue offshore debt, or we've gone into offshore indices. But we don't just blindly buy. We buy when there is an opportunity. So when
mm,
credit spreads blow out and they're very, very wide and there's just too much risk priced into a particular index or something, we will take an opportunity to get that enhanced yield into the fund. And I think of
right.
late we have seen some good ones there.
Yeah. And I believe you've got an interesting perspective on the amount of risk here as opposed to the amount of risk in
Yeah.
the US at the moment.
Yeah.
which I think our
Yeah,
viewers might find very interesting.
yeah, hopefully there are no Trump supporters online. No, I'm joking. Um, no,
It'll be
it's
about
very,
50-50.
no, we are. It's a very interesting point where we're at because Jim sort of asked me earlier what is the biggest change you've seen this year, and I think it's this whole debate around the fact that the US was downgraded in May. You know, the US has always been seen as our risk-free base rate, you know, the rate that we base everything off. But given, you know, their fiscal deterioration, the sort of the worry about the compromising of the independence of institutions, i.e. the Fed, etc., the US is seen as less risk-free than it used to be. And off the back of that, emerging markets, and in particular South Africa, has been looking very, very, very good. And we've had a lot of foreigners actually buying our bonds, so being very interested in buying our bonds and coming into our bond market, which is a total change compared to where we
Great,
were, you know, a while ago.
great news. So that from a perspective that very few people get to hear. That's great
Yes.
news. Yeah. So, what changes have you made recently, and what changes might you expect over the next few months to the end of this year, Bronwyn?
Yeah, so I think just you know, following on from that change in the US
Mm,
risk-freeness, we have been seeing value in the Govy bond curve, and particularly for an income fund, it's always important where you position on the government bond curve. So normally you would be on the short end, but lately we've been finding opportunities on the longer end where yields are much higher. So we have been switching out of short bonds, going into longer bonds, which would bring about more duration or interest rate risk into the fund, but we think that interest rate risk is mispriced again. So there is an opportunity there. I think going forward, you know, the big question is rate cuts, you know, what rate cuts are actually priced in. I think that inflation is, you know, the whole lowering of the inflation target has brought about this
mm,
big debate of where the MPC is going to see rates. We are seeing rates sort of on hold for the next little while, and that's based off the fact that inflation is going to be elevated for the next 6 months or so. But then coming down thereafter. So I think this whole lowering of the inflation target is going to mean we're going to go into a lower real rate environment over the longer
right.
term. It just might not happen immediately.
Yeah. So is that your last slide that you have for us today?
Yes. So the last slide shows essentially what is priced into the US in terms of
Hmm.
rate cuts, and that's obviously the pressure that the US is feeling. It's not only the pressure. I mean, obviously there's a lot more that goes into it, but the pressure that the Fed is feeling to cut rates versus
Mm,
our red bars. You can see our rate cuts are much more subdued. So we think that our rate cutting cycle is not going to be that based on sort of elevated inflation for the next little while. But then over the longer term, the SARB is doing the right thing and bringing the inflation target down, and we should see rate cuts ultimately sort of halfway through next year and going to 2027.
all right. Well, if you want to stop sharing the charts now, we can just finish off, Bronwyn.
Sure.
Yeah. All right. Well, great. Well, thank you very much for that. So I think what you've pointed out to us is that you can get very good, consistent returns in the South African market, but you have to be very active in terms of where those allocations are going, and you might, from time to time, use the foreign markets to get some yield enhancement. Um, so, what would you say to our clients and our investors for this year and going forward? I mean, you've been through the last 10 years, which I think has been,
Mm.
dramatic enough for almost anyone. So,
Mm.
what would you like to tell us to make us sleep at night, Bronwyn?
Yeah, I mean, I think, you know, the most important thing for me when managing an income fund is that I can sleep at night because you
Yeah.
never want to have capital losses. So, you know, risk-adjusted returns are absolutely at the forefront of our mind. I think the way the portfolio is constructed is also key, that there's a lot of diversification. As you said, Jim, there's a lot of different strategies in the fund that we utilize. So, I feel like it's almost a multi-scenario type fund that, one thing is never going to blow the fund up or anything like that, and so diversified. So I think that's very, very important in the income space. And each and every opportunity that we find has that yield enhancement, that sort of target that we have in mind of Steffi +2, but with not too much risk. So we're never going to bring in, something ridiculous into the fund in a huge size. It's going to be, very, very small position sizes, very diversified to bring about that consistency that you're looking for and that security.
Great. Well, I think our clients really appreciate it. We really appreciate it. Thank you for all your hard work, you and your team, Bronwyn. I know that you've got a very active and professional team behind you as well.
Yes, we do.
So, it's wonderful that we've got a very nice allocation to your portfolio, and thank you for appearing on the show today. So, with that, we can say goodbye and have a great evening.
Thank you, Jim, and thanks to everyone that listened to our story. Thanks for your support.